Hello, welcome to Timing World Affairs and Timing the Markets. Two things that go hand in hand, and right now we're in a time of revolutionary change. We have Brexit in Europe, we have Donald Trump in America, we have all sorts of things going on all over the world. But first of all, let's have a disclaimer. Trading stocks and all other financial instruments involves risk. Past performance is no guarantee of future results, and we make no representation that anyone will or is likely to achieve similar results. So let's move on. By the end of this session, you will know how to forecast world events, and you'll also know how to forecast market crises, and the two go hand in hand. Hi, I'm Andrew Pancioli from the Market Timing Report, and also co-author of 0 Hour, a book that shows how cycles come together across financial markets, world events, and everything. And I'm going to lead you through some of these to show you why we are where we're at right now in this exciting time in history. And I'm going to bring in a cycle that some of you won't have heard of, and it's really the populist cycle. It's when people have had enough, and it's around about 82 to 84 years long. And if we take this into account, looking at 2017, we'll see that Donald Trump gets elected. There's a lot of change in America, change like of the magnitude not seen before. Britain is in the process of Brexit. Spain is going up. There's revolution there, and there's lots of things going all the way over around the world. So go back 84 years from 2017, and pretty much to the week that Trump was inaugurated as president, Hitler became Chancellor of Germany back in 1933. Now, I'm not saying that Trump and Hitler are the same kind of people or anything like that, but what we are saying is it's a time of populist change. The people have had enough of existing conditions. And go back another 84 years, you go back to 1849. Between 1848 and 1850, Europe was in revolution because Karl Marx had just published his Communist Manifesto with Engels and had told the workers to rise up and break free of their chains. Go back another one of these cycles, you get to 1764, and this was the time of the American Revolution, when the Americans were getting fed up of the British and were about to declare independence. So you can see this is a very popular time cycle. Now I know this is generally a market and trading forecast forum here, but we'll be coming on to that, and if you pay attention to this, you will benefit magnificently. But let's take a further look at these populist cycles. So looking at this, we can go back 250 years back from now. So that was 3 of those cycles that we already talked about, and I'll put them together for you in a minute. So right now we're in a period of revolution, 2017, whatever you want to call it, and it's a window really, 2008 to 2023. Go back 250 years, and we were in the American Revolution, 1765 to 1783, Declaration of Independence in 1776. But go back another 250 years, and it takes us to 1517. Halloween, October 31st, 1517. I know the calendars have changed slightly, but go back there. Martin Luther nailed his 95 Theses to the church door in Wittenberg in Germany, thus starting the Reformation and challenging the work of the Pope and Catholicism. So you can see these were big 250-year super cycles. And as you can see, as I just mentioned, these little sub-cycles, 3 of these 82 to 84-year cycles there, all fit nicely in between each of the 250-year cycles. So that picture shows you that. Within that, though, let's keep looking back at these little sub-cycles and have a look at this little chart here. And what you can see, as I said already, 1765 over here. This is the first American Revolution all kicking off. 1793. France is in the thick of revolution. They've had enough of these aristocrats and royals. The people rise up. They've had enough of Marie Antoinette. The French Revolution is in full force in 1793. Go on to 1821, and after centuries of rule, the Ottoman Empire loses control of Greece. Panama and Peru broke away from Spanish colonization, and Faraday also invented the electric motor. Now I bring that latter point in because that was the beginning of technological revolution. I already told you about 1849. Basically in 1848, Friedrich Engels co-authored the Communist Manifesto with Karl Marx and basically urged the working classes to rise up against the oppression they were facing in the Industrial Revolution. Moving on to the next cycle in the sequence, Russia declares war on the Ottoman Empire, Britain annexed the Transvaal in South Africa. So this is a big year of change in 1877. 1905, Russia enters a crisis, a huge set of crises. There was a huge famine. People were starving to death, and this led to violent uprisings. Meanwhile, the Japanese Navy wiped out the Russian Navy. It's all happening. 1933, I already told you about Hitler there coming in. He actually said he wanted to make Germany great again. He was fed up with the way the Germans were being treated after the First World War. The reparations they had to pay and the hyperinflation they'd been through. He was going to make Germany great again. That was his phrase. Then we move forward to 1961. The Bay of Pigs invasion failed. The Berlin Wall went up. And Russia won the space race as Yuri Gagarin made history. The Cold War is in full swing. As I say, this is a 28-year cycle. So 28 years later, in 1989, the Berlin Wall comes down. And it's a 28-year cycle. The Berlin Wall was 28 miles long. How interesting is that? Something about price and time squaring out, or distance and time squaring out there. Then we head to 2017, which is where we are right now, and there's so much happening around the world. So we can put this into context, and you can see how these little 28-year periods fit into these 84-year periods like this, and then there's the big 250-year period like that. So they're all fitting in, and you can see all these cycles are coming together now. The 28-year cycles, the 84-year cycles, the 250-year cycles are all coming together then. So that's what it's all about. Spain, in the last few weeks, in October 1934, shortly before the Spanish Civil War broke out, Catalonia decided it was going to be independent. It was going to break free. Madrid sent the troops in. And that's exactly what's been happening right now. 184 year, or actually 83 in this case. But you can take this cycle of 82 to 84 years back 3 more times, and you will find that Catalonia was adamant it was breaking free. There were the Carlist Wars. I'll leave you to research that. So this is all quite interesting stuff. Using the same thing, going back to 1773 to 1775, i.e. 250 years cycle back, we see the Cossack Rebellion and Pugachev's Russian rebellion, the Peasants' War. This means that Russia will likely destabilize round about 2023 to 2025. This is a 250-year cycle from then. Now think about that. If you guys are investing or trading in minerals and commodities that are related to Russia, think about the Russian currency. All these things are going to be in the spotlight. And that is why it pays dividends to look at these long-term geopolitical cycles. So 2020's Russia is going to be in the spotlight. Mark my words. And 2045 is another cycle date that comes in the same sequence that's going to also see things happening there. You can read more about these geopolitical cycles in a book called 0 Hour. It came out this week. 0hourbook.com, www.zerohourbook.com. You can order it from there. I've co-written it with Harry Dent, Harry S. Dent. Many of you will be familiar with him. We've put my cycles working along with his, and he's got the whole series of solutions there, and we go into a lot more information on all this sort of stuff. And for those of you who don't know, Harry Dent he's a New York Times best-selling author and Wall Street Journal best-selling author of many economic and financial books there. So I'm very honored and privileged to work with him. Now let's get on to the good stuff. There is clear mathematical order in events, as I've just tried to show you. And what we do here at Cycles Analysis and the Market Timing Report is we keep a crisis matrix and timelines, and we look for these patterns. And this shows us, for example, this is one of our crises matrices that relates to financial panics and things going on. And when we look at this, this is how we decipher all the patterns. And what I'm going to do now is show you some of these long-term cycles, because that's where the real secret lies. So hopefully you'll find this information very useful and you'll be able to use it successfully yourselves. And it's all about knowing where to look. One of the cycles I'm going to talk to you about, I can't do them all, it's only a short 45-minute presentation, but one of the key cycles is the 72-year cycle. And let me show you how this works. Why the 72-year cycle? Well, let's start off with the 1929 crash, because you'll have all heard of that. Biggest stock market crash in the history of American markets, and of course it had reverberations and vibrations all the way around the world. Add 72 years to 1929, and we get the 2000 to 2001 tops in the equity markets. That was the end of the high-tech boom. Pretty simple. 72 years, add 72 years, subtract 72 years, you'll see really interesting things happen. And talking of subtracting 72 years, take 1857, subtract 72 years. Sorry, let's take 1929 and subtract 72. We get to 1857. My excitement, I'm getting carried away here. Or you can take 1857 and add 72, and that relates back to 1929. That's how it works. 1857 was a massive panic. It happened in Europe. It happened in America. And this is what happened, folks. I mean, by all means, research this. You'll find it's fascinating. But we saw a collapse there, and the American stock market was down 62%. That's a big move down. And in 1929, the stock market was down 90%. These are big moves. These are big moves. 2000 to 2001, which was the 72-year cycle from 1929, so the market down 40%. Still significant. Imagine where that would take us today if we were down 40%. So, what's the next crash cycle in this series? It's pretty simple. It's 2073. It's 2001 plus 72. You can write that in your wills for your grandkids, or tell your kids if you're young, or if you're really young, you can wait to trade that one yourself. But I can assure you there's pretty much almost certainly going to be a 2073 crash. So another cycle I want to talk to you about is the 144-year cycle. Why the 144-year cycle? Well, take the 1864 Civil War and go back to 144 years. You get the 1720 South Sea Bubble and the Mississippi Land Crisis, where John Law basically convinced the French that they should do this, that, and he created an unbacked currency, a central bank, the whole lot, and it went absolutely crazy, and we got the biggest financial panic in modern history, really, then, 1720. At 144 years to that takes us to the thick of the American Civil War, 1864, 23rd of August, 1864, cotton trades at $1.89 a pound. Well, up till then, it had been trading at 3 or 4 cents per pound. No, it was 2 to 3 cents a pound. So there was a 60-fold increase there during the Civil War. Why? Because men left the fields to go and fight. Equally, they needed cotton for their uniforms, for the armies. So there was a great surge in demand and a massive decline in supply. That led to this super-duper price rise, commodity inflation. 1864, add 144 years to that, takes us straight to the 2008 commodity boom. Two double tops there in 2008, significant commodity boom. So you can see how these cycles are working. 144 is basically double the 72-year sequence. 2008, which was the last commodity boom in that sequence, plus 72 takes us to 2080, and then 2152. Write those down. Tell your great-great-grandkids. So long-range forecasting is super easy. The next cycle I'm going to show you is the 100-year cycle. Let's take the 2007 financial panic. A lot of us knew that was coming up pretty rapidly because it was 100 years on from the 1907 rich man's panic. And that was quite an event. Half that cycle is a 50-year cycle. The 1907, by the way, panic, that pretty much, the 2001 pretty much mirrored the unfolding of the 1907. Credit dried up very quickly. There'd been an overexpansion of credit. Half of that cycle takes us, take 1907, go back 50 years, 1857, sounds familiar. 1907 plus 50, 1957, and then 2007. 1957 saw a massive slowdown in manufacturing, and basically that's when automobile production kind of made a peak, and then 2007, of course, we've seen. So 1857, I said to you, does it sound familiar? Of course it came up in the 72-year cycle from 1929. Now you can see how these cycles are all starting to twist together and mix together. All these years, including 2007, especially in the UK, all had runs on banks. Okay, so banks basically collapsed, and there was literally a run on the Northern Rock Bank in 2007, 2008, back in 2007. That's the 100-year cycle. So just be aware. We think we live in the modern age. There can't be runs on banks. There can be. So the next one in this cycle, okay, you're going to look at 2057, I guess. So this is how it works. Now, 2017, and we're at the back end of it, and I really, some of this information, a lot of this information we were putting out a year ago, but we still need to bear in mind what's going on, and I want to show you why 2017, which is right now, right here, right now, is so important in the world of markets. And we're going to combine the cycles and look at the evidence. First of all, it's a year ending in 7. So most of you know that years ending in 7 tend to be bearish. In fact, within the last, I think, 110 years, 120 years, 110 years, every year ending in 7 has had at least a major pullback or a crash or a correction in it. Okay, that's very, very important. So 2017 is a 10-year cycle on from 2007. Okay, first point. This is what happened in 2007. The market was down 54%. For those of you who are about then, you might recall what happened when the CDOs, the CDSs, etc. started breaking the banks. They were basically just absolutely made of paper. There was just no substance to them, and the big banks had invested heavily in them. The government had to intervene. JP Morgan was bailed out. Ironically, 100 years earlier in the 1907 crisis, JP Morgan actually helped bail the government out. So, coming back to this, we are 180 years super cycle from 1837. This is really important. 180 years is a very important cycle. I mean, we can just touch on it here. Basically, 90-year cycles are important. 180-year cycles are very important. Back in 1837, we had massive expansion in the Chicago area, railroad shipping. Basically, it was time to open up the canals, and they wanted to get all the Midwest farmland crops out through the through the Great Lakes, so they could take them up the St. Lawrence Seaway and ship them around the world. So it was important to get the canals going up to the Great Lakes. And the government made land very cheap, and it was fantastic. And Andrew Jackson was against this, or against the way some of the banks were giving out the money, and it came to a sudden boom and bust. Land speculation around Chicago was phenomenal. It boomed, and it went bust. And it went down 74%. And I think this is a very important cycle we need to be aware of, because we are in the throes of something like this over the next few months, or possibly the next year or two. So that's 1837. We're in the 144-year super cycle from 1873. Those of you who've been paying attention know the 144-year cycle is important. We've shown you how it works. This is what happened in 1873. A pretty reasonable panic for its time, not a massive one, but the market was still down 20%. Imagine what would happen now if the market was down 20%. So, and that to some extent was to do with gold and silver and other things. The 100-year cycle from 1917. So this was quite an interesting one. That's weird. 2017 is 100 years on from 1917. This is what happened in 1917. The market came down 45%. This was because we're in the third year of World War I. Basically, the Allies had felt confident that they could win and defeat Germany in the First World War. They didn't realize it would take quite so long. And when it got to the fourth year, well, the third year, they started panicking a bit. And this is what happened. We got this massive correction of 45%. A running correction over several months, in fact, over a year. So that's an important one to point out. We're also 60 years on from the 1957 sell-off. And we saw there in 1957, which is the 60-year cycle, they're showing the 60-year cycle from now, and it was a 50-year cycle from 2007, just to clarify that. The markets were down 20%. And so this is partly due to the fact that automobile production had peaked. You know, people who could afford cars had got them by now. Finally, well, not quite finally, but we're in the 30-year cycle from the 1987 crash. And that was in October. We've just gone through that window. And in 1987, the market came down 37%, as you can see there. So quite a big move down, So combining, the cycles, we're a year ending in 7. We're 10 years from the 2007 crash. We're 180 years from the super cycles of 1837. We're a 144-year super cycle from 1873. We're a 100-year super cycle from 1917. We're a 60-year cycle from 1957 sell-off. And we're a 30-year cycle from the 1987 crash. And for those of you that have been reading the market timing report already, subscribers, this is really quite fascinating. Basically, we've been talking about how the US would divide in the years 2017. I've been writing about it for the last 2-3 years. Now it's pretty evident. You've seen the rioting, the Antifa, and this and that, and all the rest of it. Trump coming in, other people not being very happy with what he's doing, and other people being happy with it. And you can see, this talk, the Civil War cycle specifically, being tearing down historical statues from the Civil War, which really just are a notion of history, not necessarily representing the deeper areas, well, depending on what view you have. But anyway, we forewarned you about this over 2 years ago. This has now happened. 2017 is definitely a potential or landmark turning point year. That's what the message is here. So I'm going to just run through some stuff for 2018, just to give you a heads up. 2018 is going to see the 45-year cycle from the 1973 oil crisis. So this is when OPEC and the Arab states basically took control of oil prices and hiked them up in protest of American intervention in Israel and so on. And this caused a massive depression. The price of oil went up. The US economy and the Western economies, European economies came to a halt. It was big stuff. Also, if you look at history 100 years ago, from 2018, there were a lot of human rights and women's rights issues going on. This sort of stuff is going to be going on, and it's going to get bigger and bigger. There's no doubt about that. 2018 was 100 years on from the Russian Civil War. I already told you how Russia is going to go through a lot of change in the next few years, in the next decade. This is really going to start becoming evident from next year. There was also a big flu epidemic in 2018. Remember, 2018 sees the end of the First World War. Big flu epidemic. Think about this. If you're an investor or a trader, there's likely to be an epidemic. I don't know if it's going to be flu, but which pharmaceutical companies are going to be in a position to create whatever's needed in terms of vaccinations or whatever it is you might need if there's another epidemic? Put it on your radar. And also, 2018 is a 144-year cycle from the Ottoman financial collapse. That's the Turkish area. So I think that whilst Turkey had been very strong for a few years and started flagging a little bit recently, there's going to be some issues in Turkey over the next year or so. Coming up to the super macro case for 2019, of course, we've got a lot of information on this as we go through in the market timing report, and I'll come to that in a minute. But 2019 is 90 years from the 1929 crash. This is a super big cycle. This is going to be a really big cycle coming in. Okay, that's, we talked about a 45-year cycle a few minutes ago. 2 45s equals 90. 2 90s equals 180, and you saw the 180-year cycle for 1837, if you remember. 2019 is also 45 years, half cycle from the 1974 low. So I told you about the Arab oil crisis. The crisis went from 73 into 74, and we got into a very big depression with a low in 1974. So there's a big cycle there. And, that there, if you take the 1929 high and go 45 years, that obviously it takes us to this crisis here in 1974. So these things are kind of mathematically very curious. 2019 is also 100 years from the 1919 oil panic. So I think there's going to be some big stuff happening around oil then. I'm just wondering if oil is still going to be that important. Excuse me. I mean, it might well be that a lot of car manufacturers have developed the electronical technology into a very advanced place. So let's see what happens. There are other cycles coming in as well, but we can look at those as we approach 2019. So, and here's that thing I was telling you about. Here's 1929. Here's the midpoint. This is a logarithmic chart, so the 29 crash looks a lot bigger, and this looks a lot weaker, but there it is. Major low in 1974, and we project that forward, giving us 2019. And 1919 we talked about there. That's the oil crash, and you can see that wasn't just oil, but a lot of things. And then we went up to a peak at the end, and then we just came down for year and a half, so that just bear those in mind. But that's 2019. We've got 2017 to finish yet, then 2018 to get through. So from history to profit, we always see great opportunities, but we face two problems. We get in too early and our accounts run out, or we get in too late and we miss the boat. Has this ever happened to you? So we need to be able to fine-tune the timing. And how do we do this? Well, here at the Market Timing Report, we have built a whole series of systems into a computer program which is very complex. And we sum these up at the bottom of the charts with these histograms, as you can see here. And what you'll see is that where these histograms peak, the market changes trend. High there on that peak. High there on that peak. See that there? Actually, a low there and a big move down on that peak there. High on there and a low on there. And that was just the end of that trend there, so not quite so strong on that one there. And these are future peaks, so we know this is going to be an important peak. And with this information at hand, it gives us a strategic advantage. So when we know where these things are coming in, we can protect our positions if we're already in there. And if we're looking to reverse, then we just look for the market to confirm, and we have some good information. And so we project these, here are S&P turning points all the way through to 2022, just shown on this chart. And you can see, this is a slightly bigger time scale, but you can see how all these things here are coming in. And this is very valuable information. So here's the euro going back to 2014. We got this in real time. That's just when we started publishing the report. There was a massive monthly macro cycle. As you can see, this massive peak here tied up with that. But also we had a weekly intermediate cycle. So what we're saying is we saw a very big cycle, then we saw an intermediate cycle also coming out. So we were able to say, hey, look, there's a big thing happening around about here. Then we saw a weekly cycle, so we're fine-tuning it there. And then we got the daily cycle, and you can see here the weekly cycles and the daily cycles together, and the actual, there's the daily cycle there, and that pretty much exactly caught the high to the day. In fact, it did. So that's how this stuff works. To give you an idea of what we're doing here, I mean, what we do is very complicated, and we're trying to make it simple, and we put it in the Market Timing Report. Yeah, there's a better picture. Super macro cycle, intermediate cycle, daily cycle. Here's the warning. Yeah, it's getting close, and there it is. So you can see how that works there, and you can see there's some highs here on those peaks there, and again, same there, and so on. So we can fine-tune it to the day using the super big cycles. So that line up there helps us very clearly identify these things. Crude oil, big sell-off coming up, same sort of deal. This is what we were looking at when the report was being published. Big cycle, and then the intermediate cycle. And, actually we back-tested this. This wasn't working. Oh, no, it was where we did have it running by then, of course, yeah. So, I'm sorry, I was thinking this was the oil crisis way back. Here we go. So we had the macro cycle and the big spike, and that gave us that there. And we can see something brewing here in the future there. That's looking interesting, and we'll tell you about that in the Market Timing Report. Now, some of you who watch our presentations know that we gave you some forecasts last year when we did this, and in last October's forecasts, and I'll give you some dates as well for you, in case you're not so sure about this. You can see them unfold. You can write these down and make of it what you will. Remember, we do fine-tune these things, but last October, last year we did some webinars, and this is what we said. So this is relating to last year. We said last year, weeks 4th to 11th of November here on the S&P 500, 9th December, and the 30th of December. So 4th to 11th November. Now, when you think back, now this was done well in advance, 9th December and the 30th of December, this is what happened. That was the election results there. Off we went, 9th December, that stopped the move, and then we went pull back sideways to down into 30th December. There's just a quick example of how these cycles work. If you had that information, would that be useful to you? If you were long here and you knew this date was coming up, yeah, you'd be wanting to protect your position, trail your stops a bit closer, or even take up part of your position. You'd have done well then, because you basically went sideways for quite a while after that. And so this can, then could have got you back in on that pullback there. Anyway, it doesn't matter. You've got to use it with your own systems. That's that example there. We also, back at this time last autumn, gave you some examples on crude oil. 21st of October, it says now. This is the slide I showed you. That's why I just added 2016 there. That was 21st October 2016, 9th December. That's what happened. There we go. Very clear turn there, and a very clear turn here. This was included in the reports as well. These are just a few taster cycles. Gold. Again, back in, we said the 9th of December, 14th of April, There it is, 9th of April. And it was, yeah, just those two cycles we gave you there. So, and that's pretty much, two major turns there, looking in. And, those forecasts were made several months in advance. So, right now, I want to share this with you. This is a really interesting thing that's going on. I gave you all the information on the super long-term cycles for October. And in our system here, we have a massive histogram peak here in October 2017. Now, I know it's November. Stay with me. Have a look here. Each of these cycles here made significant peaks, and this is the tallest spike. So we thought, something must be happening. And the chances are, well, we're heading up like this. Would this move come to a halt? Let's have a look, see what happened. So we were talking about it in the market timing report, and in the October edition, which was published at the very end of September, beginning of October, I put these key dates on the cover here, 3rd to 5th, 16th and 25th of October. And basically, then The Economist printed this on the cover, bull market and everything. Well, some of you will be aware that Time magazine has this thing where it puts comments on its cover and then the opposite happens. So I got really interested. I thought, wow, this is cool. October 7th to 13th. This is a contrarian indicator. However, this is what's happened. The S&P 500 index has carried on up here into, this is October 2007, and it's carrying on up a little bit more. So I was thinking, okay. I mean, it's decreased its rate of acceleration from here. The Dow, okay, made a high here, then came back a little bit, just popped up a little bit more, looking a bit weaker. But this is kind of like, well, is this leveling out? Does this cycle herald a sideways move before it heads down, or is it just pausing to pick up strength? Well, let's have a look. Then I was scratching my head thinking these cycles don't usually fail because the mathematics behind this is very complex in our computer system. Then I looked at the Russell 2000 and check this out. Here we go. This is it, October the 4th, exactly as planned. That was the high. We haven't taken that high out. The mid caps have stopped climbing exactly on cue. And look at this, the Dow transports. Okay, now this is very important for those of you that understand Dow theory. They made a high around about the 13th of October. These are the dates we put on the cover I showed you. If it was 3rd to 5th of October, 16th October, and 25th October. That there saw a major high come in October. Now, if you don't know Dow theory, the whole point is the industrial averages are going up, but the transportation averages are going down. That means manufacturing is still taking place, but the demand for transportation has dropped, i.e., people are not buying the stuff that's being produced. This is a very big warning sign. So I don't think this October 2017 histogram spike is over yet, and I think we should be very cautious about the state of the market right now. And because we saw the Dow Jones Industrial Average and the S&P 500 carry on up into November, but we saw the mid caps and we saw the transports go down, we're getting what's called a divergence, and this is a major warning sign. This is very, very important indeed. So that's where we're at right now. What's coming up next? Well, like I did last year, I'm going to give you some dates in case you're watching this time next year, or if you're on board, just this information hopefully will be useful to you. There's some major cycles coming in round about the weeks of the 12th January 2018 on the S&P 500 and other US indices, as well as the 23rd to 30th of March. Mark those in your diaries, important dates. Gold, weeks of 22nd December 2017 and the 23rd of February 2018, important turn points. Crude oil, very big turning point showing week of 13th July 2018. How do we use this information? Well, basically, if you've got positions in these areas, you'd want to be safeguarding them if the market is... do we know if it's going to be a high or a low? No, we don't. We don't know if it's going to be a low or high, but we know which way the market's going into that area. So this gives us heads-up warning. It's like night vision goggles. It's advanced warning. It's great stuff. So you have to use it in conjunction with your own bits and pieces. So the benefits of the market timing report, if you're managing your own 401ks, that's great. You can use this information in protecting positions, looking to get in. But again, use your own systems. It's not a standalone product. Your retirement funds, again, it's not about making your broker rich. take advantage, use your own knowledge and grow it and learn. And we do tutorials in our reports as well to help you become self-sufficient, with how to use these techniques. So personal empowerment comes through you knowing how to trade and manage your risk and knowing where things are likely to change and you managing it accordingly. Some of these turning points fail, I'll be honest with you, but if you protected your position and trailed your stop, then you're not going to lose out. So that's good stuff. And it's a useful tool to add. It's a very useful tool to add to your decision-making process. So what the market timing report does, we look at 5 markets: the S&P 500, gold, crude oil, the dollar index, and the euro. And it comes out every month. I put the key dates on the cover every month, what I see that's there, a little bit of editorial and a little bit of geopolitical comment. And those key dates, when we these are the ones since we've been going. So it looks like, we've been going since 2014. Not that long, but these are all the swings we've picked here. And we've pretty much picked every major swing. Yeah, we missed a couple, or there's a couple there. There's one there. I think there's one there. There's one there as well. But everything else we've caught there. And we've got a lot of very satisfied customers. Now, you might be a trader, you might be an investor. If you're an investor, just look at the bits that we put in red. This is giving you where the key intermediate cycles are going to, this is if you're position trading over several weeks. This information is useful to position traders, as it were. It's all in red. So that's for investors. And we look at a lot of decennial cycles and we tie them all together, and you can understand the methodology, you explain it, and that gives us some really good ideas of potential direction. And we look for the reversals. As I say, you know which way the market's going, so usually you can tell which way it's going to change, where you see these correlations and decennial patterns. We also have in our software system where we get the input, we have like days, so since 1984, for example, crude oil has been up 78.3 occasions on the 29th of September, so just for that one day. So again, if the market's heading up and you're on the 28th of September, then the 29th will probably head up too with that probability. But again, it's just an information point that you can add to your own decision-making process. Very useful stuff. Most important thing, though, about the market timing report is our profit-finding oracle dates. These come from these histogram sets. So the daily sets we put here, we give you the key dates for each month when we're expecting turns. So, for traders, or if you're looking to fine-tune getting out of a position, this is where we see the most cycles coming together, suggesting a potential turn. We also look at seasonal probability. Now, seasonal probability is just different. It's just regular seasonal probability, but it's very useful. So, for example, gold, for example, in parts of September is bullish at the back end. They're, between the 13th to 28th, and we see that 75.6% of occasions since 1983, I think we used in this date, gold closed higher on the second date than it did in the first date. And this is regular seasonality. Now, you see, when you combine this seasonality, I'll come back to that chart, the seasonality with the profit-finding oracle systems, which are very specific only to that year, to the specific month, then you can fine-tune. For example, if the market was coming down and we had a PFO, profit-finding oracle date, on the same date that we might see a low in gold, then there's a high probability that the market's going to turn around. If you were short, you'd want to get out, and then you want to look for the market to confirm that it's heading up before it heads up. So, that is, again, information you can add to your armory. Sometimes I'll put some, my team here will put some price and time setups together where we see them. Here's one. This is what we call the top of the euro that I showed you a little bit about earlier. And a lot of people use the daily PFO, profit-finding oracle dates from the histograms. They can confirm whether a Fibonacci level is going to hold or a pitchfork is going to work. You see here, the market fell shy on this PFO date. You can't quite see it there, of the top of the pitchfork. So people might think, well, it's just going to go up and squeeze higher if they don't have any timing information. But because the date was there, you'd know to get out. And actually, that was a trade that I do remember taking very clearly, and it was very useful there. Nice stop and reverse strategy there. But also, whether the market's going to stop at a 382 or a 50% level on a Fibonacci level, etc. So it's just information you can throw in. We give you a summary of the key timing points, and sometimes we'll see a whole line across like this, and we know if that's the case, this date, and I think this is actually from 2016, this one, but this would be a very key date across a whole series of markets. So, that's when you see big economic events occur. Otherwise, this is US equities, crude oil, gold, dollar index, euro, all there. And people love the geopolitical comment. I used to just write it as a bit of fun, and people want more of it. And one of my great heroes, Winston Churchill, said, "The farther back you look, the farther forward you're likely to see." And so we put some of this stuff in. We've been uncannily accurate just because we use cycles, not because we don't know anything clever. Just seeing world events unfold. That's very, very interesting, and and a bunch of the readers that we have now become students of this and have done very well. They combine this and they can see world events falling apart or happening or whatever's going on. So basically, you can use this if you have a fundamental view and you want a timing input. This helps. Protecting trending positions, as I say, we always know which way the market's going into a turning point, and so we have to work with it, as it unfolds. So, if the market's going up, we've got a turning point, it might well turn down. Occasionally they do accelerate, occasionally about 5% of the time. It helps us determine whether a Fibonacci level is going to work. Say a market's coming down and it's hitting one Fibonacci level, but there's no PFO date. It means it'll probably go through it to the next level. So that's useful as well. Andrew's pitchforks, I've just shown you a couple of examples of that. Commitment of traders reports, they're great, give us very good information, and they actually provide us directional information. So I'll leave you to research that. If you don't know Steve Breezy, he's an amazing guy, does fantastic reports, and this helps giving you a timing handle, because sometimes these reports unfold very gently and slowly. Not the reports, but the numbers, start showing perhaps a market about to turn bearish, but you don't know when. And if we've got a major investor cycle in red tying up with a profit-finding oracle system readout, then that's a high probability date. So there's examples on our website, www.markettimingreport.com, and basically this is pretty priceless, but it's not for everyone. This is no free ride here. We don't claim to have the holy grail. You have to use it with your own trading systems. It does give people an edge. You need to combine it, as I say, with your own trading and investing. For less than the price of one S&P E-mini point per month, basically we're saying here this is a very special offer. Larry Jacobs is a good friend, and I love working with him. I've known Larry a long time. Every month in the Market Timing Report, we provide monthly commentary, long-term cycles, cycle pattern matches, from time to time when we see them with the seasonality. High probability, one-directional, one-day moves, seasonal trends, tutorials most months, and just by reading the charts, you'll learn things. We put some comments in with the team there. They write some bits and pieces in there. Geopolitical cycles. We have the summary sheet. Most importantly, the proprietary PFO dates. That's what makes it special. That's what makes it different. We have this very complex cycles computer system that finds these dates. Now, normally it's $97 a month. That works out $1,164 a year. As I said, for less than the price of one S&P point per month. We're going to make it available. Say Larry's a good friend of ours. Expo special only today for this webinar. $495. That's it. And not only that, you can, if you like it, and we have a lot of people liking it, you can stay on that and auto renew it at that price. We will hold that firm. That's not going to change. But you got to keep the subscription going next year if you like it. But I also know that it might not be for you. So all the risk is on me. You got a 28-day money-back guarantee. That's it. Absolutely guaranteed. No questions asked. You just write to us within 28 days saying, hey, not for me, thank you, and we will make you a full refund. So you can try it out. There's no risk to you whatsoever, and this is the link. And I believe the link will also be shown just under where this webinar is playing. So we're only going to keep it open for a very short amount of time. So there we go. That's the link there. Click on that, and we'd love to have you on board. And don't forget, I'm going to take all the risk. If you don't like it, I will personally guarantee you a full money back guarantee. So I hope this is something that you find interesting. It's not for everybody. I'm going to be the first to tell you that. You've got to have a trading system. If you're new to trading, then it's probably not for you. But it's good stuff. It comes together when you use it with other tools, and there's some great tools out there. And some people have some very simple but very efficient, successful trading systems. Love to have you on board. If you're just interested in the political cycles, zerohourbook.com is the website, zerohourbook.com. Have a look at that. And as I say, come on board. Take advantage of this very special offer. Thank you so much.